Let's work through a sample problem that illustrates the analysis process for a potential sale-leaseback transaction from both the user's perspective and the investor perspective. This segment will start with the NPV method for comparing this user decision, after which we will move on to alternative analyses. In this segment, we will calculate and interpret the net present values of the users continue to own and the sale-leaseback alternatives. Remember the NPV method for our lease versus own comparison earlier in the course. In that process, we reduce the projected cash flows after tax from both leasing and owning to their net present values at the user's discount rate in order to find which alternative had a lower cost. Now we have two new alternatives that we will compare in the same fashion. On one hand, the user may decide to do nothing. Space. In this continue to own alternative, we will project the cost of owning the real estate through the holding period and forecast a sale in the future. On the other hand, our user may decide to sell today and lease back the space. In this scenario, they receive a large upfront cash flow and then project lease payments throughout the lease term. Both of these cash flows can also be reduced to net present values and compared. 5 years ago, Value Stores Incorporated, or VSI, purchased a freestanding 50,000 square foot retail building for $3,500,000 plus $20,000 in acquisition costs. VSI currently uses the building as a retail sales outlet. VSI acquired the property without any financing. The current annual sales volume at this location is above the company average for its stores. Because of this store's superior location, the company's management feels that it will continue to perform well for the foreseeable future. VSI is trying to determine the best use of its capital. Should the company continue to own and leave the capital invested in the real estate, or should it perform a sale-leaseback and place the generated funds in its primary business? The company is looking at a 10-year occupancy period. Calculate the annual cash flows after tax from ownership for the projected occupancy period. Since the building will be occupied by the owner, there will be no income, so use 0 for the net operating income, NOI. Since the user acquired the property without any debt financing, the only deduction from NOI to calculate each year's taxable income is the cost recovery. Note that the first year of the projection reflects a full-year cost recovery, since VSI already owns the building and isn't using the mid-month convention. The last year of the projection reflects the mid-month convention for cost recovery. Note also that the cash flows after tax are positive, even though there is no income. This positive cash flow results from the tax savings generated by cost recovery. Follow along with cash flow and cash sales worksheets provided in this week's module. Calculate the sale proceeds after tax at the end of the holding period. In this calculation, the total cost recovery taken includes that from the time of acquisition 5 years ago to today, in addition to the total cost recovery taken for the projected future occupancy period of 10 years. In this sample problem, cost recovery does not alter the effective tax rate, as all gain is taxed at the corporate income tax rate. In this case of an individual or sole proprietorship, it would have a greater impact since different sources of gain are taxed at different rates. Calculate the NPV of the annual cash flows after tax from ownership and the after-tax cash flows from disposition using the corporation's after-tax weighted average cost of capital as the discount rate. Calculate the end-year zero cash flow after tax. This cash flow after tax is the sale proceeds after tax from the proposed sale of the sale-leaseback transaction, which comes up front or today. Note that this is a positive cash flow as a result of the cash to be received by the user if the user completes the sale-leaseback transaction. Calculate the annual cash flows after tax from leasing for each year of the projected 10-year occupancy period. First, use the sample problem details to construct the annual rent payments. Then, multiply those payments by the corporate tax rate for the value store incorporated to find tax savings. Add the tax savings to the rent to find cash flows after tax. We will also include sale proceeds generated in year zero. Lastly, calculate the NPV of the cash flows after tax from the sale-leaseback alternative using the same 12% discount rate. After calculating the NPVs of the continue-to-own alternative and the sale-leaseback alternative, we can compare the two NPVs. The alternative that produces the greatest NPV is the better alternative. Assuming the after-tax weighted average cost of capital is known, 12% in this case, the alternative that produces the greatest positive financial benefit is the sale-leaseback. Both alternatives, positive financial benefit is created based on the assumptions used in the sample problem. The sale-leaseback alternative produces a positive financial benefit of $2,131,870 compared to $1,502,529 produced by the continue-to-own alternative.